Welcome to the National Real Estate Network video training program. This video is part of a series designed to help beginning and experienced real estate investors with the different aspects of purchasing and investing in properties.
Yeah, so okay, so then do what? So go to home. Okay, perfect. Okay, so have my name and all that good stuff, but so real briefly, been working with investors in different capacities most of my career. Spent many years with a large national firm and then focused down to a smaller regional firm and worked with investors starting out all the way through to large multifamily, low-income credit clients that deal with. And been part of the Michigan Association of CPAs Construction Real Estate Task Force for I think like 9 years now involved, and really been involved from residential, commercial, multifamily, involved in various transactions. So really just here to share tonight and go from there. But as Mark says, disclaimer, don't sue me. Everything's kind of general of nature, and always able to focus more on your case, because one of the things I like to say is what works for you may not work for you and everybody's situation. So really when it comes down to taxes, liability, operations, number of situations, how that's going to work out. So as Mark and Todd say, everything I say tonight's lies, and we'll talk more closely, another time. But really kind of planned to talk about some general taxes for real estate. Wanted to touch on 1031 exchanges, pros and cons. Touch about cost segregation, because some of those concepts really get into the depreciation strategies, and I know there's a lot of talk with depreciation and when you renovate a property and rehab it, what qualifies for accelerated depreciation versus just standard 27.5 year or 39 year, depending on the type of property, and then really how that incorporates to your business structure depending on taxes. And then just really, I know there's people that tap sources from different transactions of borrowing money and different sources. So I think really be able to cover everything. And as I go through some of the details, feel free to throw questions, and then we can kind of tune it up to questions. I did bring something to write on as working through maybe some examples if people have questions. And so I'll kind of start from there. So one of the biggest questions I run into is everybody says they're a real estate investor, and I really like to narrow it down. I know there was wholesalers, funders, buy and hold. Really from a tax standpoint, getting a handle on what hat you're wearing, whether it's if you're a flipper, a wholesaler, or more of a rehabber, that's what I like to really call wearing your construction, or that's your Schedule C ordinary income type activity, that you're really going to run into self-employment tax issues. And everybody thinks of myself. The IRS code stipulates the taxpayer, which may be you might have an LLC that's an investor and another one that's you're funding your transactions through, such as flipping and rehabbing. You might have another activity that is doing management, and understanding how those hats impact your tax situation. Passive, which is going to be more on the rental side, is going to be Schedule E, and that's really, I think there's people in this room that purely are renting property. They might be managing their own. They're not really brokering deals, and that activity is going to be passive by nature. Then you really have more of an investment type, what I like to call an investor, might be raw land that I'm speculating on or I'm just holding. That's going to qualify more on the capital gains side, and which hat and how you present yourself is going to really dictate how you recognize taxes on those transactions. And it really gets into keeping good records. So when I talk about different hats, that's kind of what I'm referring to. Sometimes you're an investor, sometimes you're actively doing it. I might be rehabbing a house, but I can hire anybody in this room to go do that job for me. So that's going to impact how you do your taxes and ordinary income versus capital gains. So really, what's the key? That's really the key focus there. So then one of the questions I get, what's deductible? Generally in your real estate business, everything that you use in that business is going to be deductible at some point in time. How you deduct that's really going to come into play. So proper planning, a lot of times we can run into the question, what's going to minimize your taxes this year? And I think I like to really understand with the client what their longer term plan is, because you might have a property this year that might reduce your taxes, but now we've started to indicate you might be flipping that property versus more of a longer term hold. And next year, let's say I come to Jeff and buy his property, does he want ordinary income or capital gains on that transaction? And it might be how he conducted his affairs and his business, how things are going to look at. If we're talking smaller transactions, your risk isn't as risky on that situation, but let's say a building of this scale, you really want to have all your ducks in a row with transactions of those and as things happen. So really starting out small, and it might be a couple rentals, and next thing you know you own many and you're getting into multifamily, and how you navigate that, really your tax life cycle through time. So really proper planning, and then really how you conduct your business will help determine where that somewhere is, as I said, ordinary income or capital gains, and that's going to play into, as we get more into 1031s and the depreciation benefits there. So I think a lot of people hear the different benefits and strategies and don't really understand the exposure or the cost associated with them. So really want to be able to throw everything out there and let people decipher from there. So so some of the mistakes that I see quite often is deducting expenses in the wrong place, limitations on passive loss rules, which gets into real estate professional status as you start to wear these different hats and how they work. Because I run into a lot, people ask, well, I bought a rental, I'm supposed to get all these deductions. I heard Grant Cardone or somebody talk about, you know, all these deductions. Well, it's the scale of these transactions and understanding how things happen, where you're at. Or I see people starting to get into a lot of out-of-state LLCs and overcomplicating things. Really getting the documents in place and your tax house in place is one of the big mistakes that I see and really getting started is the biggest thing, but there's over-analysis or under-analysis. So let me get on to, so another thing is just have a few points here. Really not having an entity structure, documenting something that's going to defend against the IRS, partnerships with, let's say Jeff and I want to be partners. We set up with the state of Michigan, but really how are we evidencing that? And a lot of times I don't see all the documents in place, and someone paid the $50 with the state of Michigan, got the EIN number, and now they have their LLC, and they're buying houses in their personal name, getting a mortgage, then quit claiming them over so they can get into the BRR strategy that they heard on Bigger Pockets, and it never becomes an issue until it does. But in a tax situation, the first thing the IRS looks at is your operating agreement and if there's certain tax provisions and how you hold that real estate. When you refinance it, take that money out tax-free in an LLC versus an S corporation. So sometimes that lack of planning doesn't really evidence to the IRS what you're doing with that, and it's being able to go on those documents. So some other issues I see is improper allocation of values to land. If you buy a property, it's always got some land value. There's not a set formula, 10 or 20 or whatever percent, depending on the scale of the property, looking at that a little closer. And then really, I think as you navigate from smaller single family into larger transactions, understanding all the benefits there, such as 1031 exchanges, cost segregations, and how that's all going to play in there. And then also really not understanding installment sale transactions. For instance, I sell a property to somebody today, they give me a down payment and are going to pay me over a couple of years, being able to defer that gain. Sometimes I don't see that transaction properly for the investor treated as an installment sale. But that same person that's a flipper or a rehabber wearing that more of a construction hat, you don't qualify for the installment sale because that's going to be an inventory asset versus an investment asset. So if I'm rehabbing quite a few homes, someone comes around, wants to buy them on an installment sale, that's income this year to me, and I don't qualify for installment sale because I was really starting to mix that bucket differently. Had I really planned for that transaction, let's say had them all in separate LLCs, that might be an investment LLC. I'm not one to say you need an LLC for every property, by no means, but really operating your LLCs as an investor, a rehabber, a manager, and really starting to get those lines, because I might even have a property that maybe I want to flip, maybe I want to rent. I want to treat that as an investment, rehab it, and then Jeff comes along, wants to buy it from me. I just sold a rental property that, if it's a year, would generally qualify for capital gains, may qualify for installment sale. But if my pure intent was to flip that property, that's going to be ordinary income that's going to be at a greater tax rate. So being able to plan that, and if you just do all your activity through one LLC, you really muddy that water, and the IRS is going to say, we don't know what you're doing, it was all ordinary income, and charge you the most amount. And
so if you are an investor and you do wholesaling and you also do rehabbing, you do buy and hold, which would be passive as opposed to the ordinary income of the other two, would you have a separate entity for all three? Or for each one, for the passive and the ordinary income, would you have a different LLC for each of those?
Generally, depending on the size of the transactions and the frequency. For instance, if I had an LLC that owns 10 rental properties and it's just me, I'm not doing it, and I get an opportunity to do a flip transaction, let's say, I might run that through that same entity without much risk if it's just a one-off thing. But if I'm really starting to actively wear these different hats, I might want to, for me, I could go set up something and do my own taxes, and it's not going to...
Not you then, maybe anybody else.
But my advice would be really to look at the scale of that. If somebody's going to be doing a transaction on a small Detroit property, $30,000, I don't know that you need to properly go set up a new LLC, incur a new tax return. I'll do them for you, but I don't need all these extra entities. If you're going to start to wear that hat, I would say you might want to start to consider it. But so there's not really a set in stone, but if I'm going to start to do some flips and I might want to move that ordinary income into its own entity. Now, depending on the scale of that, everyone hears LLC and I think is familiar with that. Single member LLC is pretty straightforward. It's going to be a Schedule E or a Schedule C within your own tax return. Doesn't really complicate things. But depending on the volume of transactions you're doing on the ordinary income side, we might want to look at setting up an S corporation to start to reduce your self-employment tax exposure. You might want to be able to add yourself or your kids to the payroll. There's a number of things you can do. If I'm making $5,000 in an LLC after expenses through my ordinary activity, and then I've got my rentals, all of my expenses, I would say, are going to be on my rental activities, or the house expenses, but your mileage to tonight to network, your transactions that you're doing, your cost researching deals, I would say would be on your ordinary activity. And if you don't have a substantial amount, let's just keep it simple and run it through on a single member LLC. It might cost you a couple dollars in self-employment tax, but your savings aren't going to really offset the extra tax returns, the extra filing, all the extra stuff that's unnecessary. Now, if in the same thing you were doing $200,000 profit on your LLC, we might want to set up an S corporation, maybe look at hiring spouses if they're doing work, hiring kids if they're doing work. There's some strategies, I think people pay for kids, people put money away. There's other things you can start to do, and you can start to not complicate it, but start to be able to plan better. There's additional cost with that, but I don't want to do 5 tax returns just for the sake of keeping things all separated, and I'll do them if you want, but really keeping it as simple as possible. And so I'd rather you pay a couple $100 more in self-employment tax than overcomplicate it. So it really depends. But now if you were doing $1 million commercial buildings, I might say you might want to start keeping those separate, and it's going to be worth setting up a separate LLC. So so it's not really a yes or no answer. It depends, I guess, is my favorite. So one of the things I mentioned, real estate professional and passive. One of the questions I hear quite often is real estate professional. I was at another meetup and the person said it's just a box in your software to check. And when we talk passive, for instance, it's just happening while I'm home sleeping. It's delivering that mailbox money to you, as some people call it. But effectively, all of us in this room, anybody that makes less than $100,000 can deduct $25,000 right off the top of all their real passive activities. It doesn't matter if I'm passively managing my rentals, I invest in somebody else's rentals. If it's generating losses, I can get it. So the real estate professional's kind of a non-issue. I hear a lot of talk about it, but what qualifies now is, depending on dollars or the amount of losses due to depreciation from cost segregations or different things, or the scale of the properties that might generate those losses, how you're going to be able to utilize those. Through real estate professional, essentially, in a nutshell, is you have to have at least 750 hours, then make an election. Generally, most people aren't spending 750 hours on a single property, so you can group all your activities together. And when I say activities, that's your investment. It might be your ordinary activities. There's more that would really qualify as material participation, but it doesn't mean just go get a real estate license and that makes you a real estate professional. So that's a planning strategy and be able to use, but not everybody gets it. And just be aware, checking the box sometimes brings unnecessary risk.
I'm asking the questions because I know we've had this conversation and I think it's important. Can you please explain when you are not qualified to be a real estate professional?
Okay.
Licensed.
So anybody in here that's working a regular job and wants to get into real estate, I know Dave Ramsey's a big proponent, go become a real estate professional. Well, if you have a regular W-2 job and let's say your spouse has a W-2 job, you have to have not 750 as I just mentioned, you have to have your greatest activity now. So assuming it's a full-time job, we're talking almost 2,100 hours. So now my qualifying hours, your qualifying hours, whatever that may be, would be over 2,100 hours, roughly. Good luck explaining to the IRS that you work 4,200 hours a year. I did have somebody this year that I said, I'm not doing your tax return, pick your stuff up, and he and his wife were both full-time employees, had some substantial losses, and I referenced the code and said, clearly I can't do this. He picked it up, never questioned it, and I think he might have been CPA shopping of whoever was going to check the box. But so there's a little more than just checking the box and filling it out. But now on another note, let's say you have a full-time job or your spouse does. If one of you qualify, essentially for tax purposes, you both qualify. So if, let's say, husband and wife, one works, but the other one is a full-time, qualifies for real estate professional, but you have 50-50 ownership or different things with the husband and wife, for tax purposes, that unit is a real estate professional and effectively. So as you get into larger deals, you might have a situation that positively cash flows but is generating depreciation losses, and that's really the best of both worlds, minimizing your tax exposure while you're putting cash in your pocket. Some of the smaller rentals aren't going to necessarily cash flow like that and do that, so just by buying a good deal, you're not going to get all these deductions if you didn't pay for it in the first place. But we have a good market like that, but now being able to plan for and reduce that. Did that kind of answer that?
Yeah.
Or, so one situation here, quick court case this year, or actually last year, real estate investor owned five properties, amounted to 8 units. He elected real estate professional. The other investor owned 2 properties and elected real estate professional. They're both audited. They both take it to court. Generally, you'd think the guy who has more properties did it. Well, he wasn't keeping proper records and proper logs. Audit came, he handed the IRS his logbook, showed every weekend he was working. Part of the audit was his credit card bills showed he was on vacation during certain weekends and didn't really coincide with that. So planning after the fact or a year from now in an audit, so those are different things that come up, and really being able to look at that. And so I know all of us aren't probably the best at still balancing our checkbook, but the better habits you get, the better you're going to start to be able to differentiate your activities as you get into holding, investing passively, investing directly. So that's kind of some of the basics that I think are sometimes not clarified from a tax standpoint, and how you structure things from a tax standpoint may be different than a legal standpoint, but now as a landlord, maybe you want to own them in your name personally. So there's really those different factors to understand what's going to work best for you. I can tell you the different tax things, and whether you own it in this complex structure or all in your personal name, taxes might wash out to the same number. Legally, you might have different exposure, so that's why I always say really talk to everybody, and I think these groups are great. You know, a lot of times, let him make the mistake, and I just want to hear them all and go from there. So, so now,
Quick question.
Yep.
If you're going to take the real estate professional designation, what type of logs should you be keeping if you were audited to justify that deduction?
So really what you're doing as far as your travel, having mileage logs, what you're doing with that property, what you're doing and looking at deals. So for instance, let's say somebody owns a bunch of properties and is sitting on a beach collecting their checks. they might own 200 properties. You would think they'd qualify, but they're not really actively managing them. They're really more of a passive investor. But then that same person might own 2 properties, driving down, dealing with the plug toilets, dealing with tenant screening, those activities. If somebody is doing other things, has a full-time job, is a CPA, an attorney, now you need to really start to, if your only source is that you're doing all this stuff and you don't deal with a third party, your exposure is not as great, but still keeping those logbooks. Really, under IRS, everything should be logged every moment you leave your house. In reality, not everybody's doing that.
Emails between tenants.
Those are all types of proof of situations.
A digital calendar too?
Oh yeah, all of those logs. But like I said, don't produce the credit card bills or the bank accounts that show you were on vacation with the family, or the government's getting better at looking at different things. Have your Facebook show that you guys were in Colorado and doing things,
So
but
don't have conflicts.
what?
Don't have conflicts from your calendar to
Exactly.
what your calendar says you're doing when your credit card says you were in California.
Yes. Actually had another situation that years ago, a client, late 40s, father was in his mid 70s, I think that's what he was, and so they were 50-50 in the business. They both took the position as being active. The father was audited. I'm sure it was age-based and income-based, a very substantial amount of money. He had a place down in Florida that he spent the winters, and it came down to the key card swipes. He literally was going there 5 days a week, 3 hours a day. Then when he was in Florida, they were FedExing boxes of invoices to the mother and father. So that really evidenced all that, and it was just kind of at a whim. Well, how do we know he comes in? You say he does. The key cards, and actually ran that his key card had been swiped very frequently in the summertime, and in the wintertime they had the FedEx tracking, and that showed that he was active in this business.
What is the total amount of hours for the real estate professional if you're not working a full-time job?
750.
Okay.
So
It equates to like 14 hours a week.
yeah, but then that's per activity, but then Section 469 able to do a grouping election. So effectively you elect real estate professional status, then I further elect to group the activities, and then now this is my group, let's say 5 properties. Next year I add property number 6, you have to make that election again, technically with the IRS. I just make it every year, and it's easier to make it every year and not need it than so, and just group everything together. But then technically, if you, let's say, have a bunch of properties, but now you invest in other people's properties, you may not be pulling those into your grouping. Or you might invest into some limited partnerships, let's say, and being able to treat that as a separate group. So, so I mean, you can't have, let's say, potentially a bunch of profitable rentals and go invest in a bunch of limited partnerships and REITs and stuff that are going to kick out tax losses, and it's not as easy. Yeah. Pre-86, the limited partnerships, you could pass losses without basis, and that all went away. So that's kind of, I think, a lot of the background wanted to focus on, and before dive into a lot of the details of some of the transactional stuff that want to be able to cover. Any other questions from anybody, or? Okay. So 1031 exchanges, really a 1031 exchange is that you're exchanging property for like-kind property effectively. One of the things, biggest things is deferral of taxes. So like-kind property is single family, can go into multifamily, can go into commercial. I've had a client that had property, built a building in Clinton Township, swapped it for a property in Novi, sold that, split that to a property in South Carolina and Delaware, and then traded it again. It was a very structured process over many years, but it had a really weird name, and when I started digging into the history, saw it, and they deferred a lot of taxes, but a transaction like that, you really need to know what hoops. There's a lot of potential pitfalls in there, and a lot of people talk about 1031s and all these savings you can do, which is good, but you need to understand the risk and be prepared. And I think I like to understand all the facts, and if things fall apart, at least know what the worst is going to cost you. And I've seen people and heard of people get into transactions just to avoid the taxes. End of the day, it needs to make sense. How much money is going in your pocket? Taxes aren't bad if you have to pay them necessarily. It's just trying to be able to minimize them and strategize with them. So the one thing is deferral of taxes. A lot of people will argue faster wealth creation. I think it is for the right person, but I have clients that will never even finance a property. They sell it. So for them, the strength of the 1031 may not be as strong, and just exit the deal and move on to the next one. Other ones that are adding value to a property, refinancing, starting to go negative, they've kind of locked themselves in that position, and it's a great way, but you need to understand what fire pit you're playing in. So then able to really exchange properties from a single family, as I said, into multifamily. Management might be easier. You might be rebalancing your portfolio. I've had worked with clients that have actually started in an exchange because some of the negatives are the timing, but if you do it correctly, you can enter into a failed exchange with the intent for it to fail. I sell a property today, start the transaction, and then I don't properly identify, which I'll get into in a moment, the transaction, and it doesn't fail until next year, and now I've pushed the taxes to next year. The one strategy the one pitfall is right now taxes are low. We have a real estate favorable president, love him or hate him, I don't care, but the tax law is still favorable for real estate right now. That can change. Right now you're gambling on today being favorable, and 10 years from now, hopefully it's still as favorable. It all depends, you know. So right now we've got low interest rates, you know, all of that can change. But one of the things here, the multiple procedures, 45 days, the biggest thing is I sell a property, I have 45 days after selling it to identify my replacement property that I run into. Generally, I might sell property A, I'm already starting to scout property B. Somebody that's very active is always looking at properties. They already know, well, I've got a few deals I'm working on, I might just sell this one. The 45-day period starts when you sell that first transaction, property A. So you have 45 days to identify, and then what I was saying, 180 days to actually complete the transaction. So if you run into environmental issues or whatever, you could run into, if you close 190 days, you're buying the new deal and having to pay the taxes, and it's effectively a failed exchange. Then it can push you into making a bad deal just to beat the taxes, and that's not really.
What's the timeline when you do the reverse exchange, when you buy the replacement property first?
That's a little different. I have to double check that. I haven't actually worked on one of those in a while, but it is, I buy a property, I sell my property now, but I don't buy a property in January and sell my property in December. And actually, it's been years since I've run into one of those. I have to double check the, yeah, with that, generally, I can buy a property and sell the property and effectively sell my second property, and if I time it correctly. There's other strategies that, let's say somebody's selling a $500,000 property and wants to buy $250,000, you're going to have a partial recognition of gains. So now that 45 days, there's a couple situations for the replacement property. You have a 3-property rule that I can identify up to 3 properties that I want to effectively close on. It's real easy, but now you can get into 200% rule. So let's say I'm selling for $1 million, but I don't know what I'm looking for and what I'm going to do, and I'm selling $1 million commercial building in Michigan, and I want to go down to Florida and buy some multifamily or single family. You can identify unlimited number of properties, but only up to 200% of the value. So there's ways, someone from Michigan retiring down to Florida or wherever, to strategize with this. Then you can also identify unlimited number of properties, but you have to close at least 95% of the deals. And while this is happening, this 45 days, I don't get my money. Jeff doesn't buy my property from me and I get the money, then I go buy a property from Todd. We do the transaction and I have to get involved, a qualified intermediary. So on a commercial property, generally it's going to make sense. Those costs can start to get substantial. Depending on the scale of the property, they're effectively holding your money and I cannot take possession of that property or the dollars while that's happening. So all of your expenditures to go research that, you don't have access to your cash, so you have to have cash elsewhere. The other thing to consider is, if you're selling a property in Detroit, let's say for $40,000, the costs incurred may not make sense to do that. So I run into that sometimes. But now let's say I have 14 properties in Detroit that I want to sell because I want to buy a multifamily. You might be able to structure that and work with an intermediary that might positively or be able to give you a deal on that funding if you were able to sell those. You're not necessarily, there's always fees associated. So you have to look at the fees and how different things happen. The biggest thing to understand is your reduced basis of property. And what you run into is, let's say, Dad, or, I bought a property, when I was really young for $500,000. I've held it for 27 and a half years, and now it's worth zero to me effectively for my basis. And I can get into that a little bit closer, but I've depreciated that property. If I sell that property for $600,000, it sounds like a $100,000 gain. That's a $600,000 taxable gain on there. And now once you straddle it with mortgage debt that you've taken and you've spent, you run into negative basis issues, and that's a whole nother scenario itself. But the reduced basis would be my first property I sell for zero, that Jeff buys from me for $600. Then I go buy Todd's property for $800. That's only $200,000 more, so I had to come up with $200,000 of cash. My new basis in my new property is only $200,000, so I don't get to depreciate another $800,000 property. So, end of the day, I didn't pay any tax on it. So, and I now own hopefully a better premium property that's cash flowing or doing something. So, is the whole scheme of things. Or maybe I'm going to go get that property and now go leverage it with debt, and now really the reduced basis, then losses cannot be recognized, but generally if you're losing money on a property, just sell it, cash out, and go buy something and take your losses. Now you run into wearing that investor versus operator hat, because generally on investment property, if it's not fully depreciated, your losses are going to be capital losses, which are going to run into limitations up to $3,000 a year. But on the same note, if I buy a property with the intent to flip it and I lose money, I want to be wearing that ordinary income hat because I get to take those ordinary losses earlier in our conversation. So again, your ever-changing tax rates are another issue. Then I always tell people it's tax deferred, it's not tax free, unless you effectively hold it till you die. And I have clients that effectively the next generation comes in, I've worked with, third generation companies that are passing it down, but that's people that are living and breathing real estate. They're not looking to sell everything and retire down to Florida. They have to understand what they're getting into. Actually working with another individual, 82 years old, that he was a real estate professional for many years, had very negative basis on transactions, and as I was referring to basis from leveraging them with debt, he needed to hold that interest in the LLC till the day he died, and it just goes to zero. It's called a step up in basis. He effectively got mad at his partners. They bought him out for $1. He had $1.5 million recognition of gain, and then came to me and owed the IRS $600,000, and so worked on an offer in compromise, ended up settling for $10,000, but because of his age and the facts, his future earning potential, that's not happening to somebody, and somehow the IRS agent understood that he effectively needed to hold it for a few more years, and they would have never gotten anything, so they took the money, and but yeah, that literally would have wiped out his entire legacy, and that was straddled with 1031s, aggressive depreciation, mortgage refinancings, all the strategies that everybody hears but doesn't know how to implement. But he was retired up north. His partners still kept him in this deal, and he got tired of waiting for his K-1, and that's why they bought him out. So I think really understanding all of that. So because all these strategies are really nothing new, nothing about them, everybody talks about them, but I think understanding all your risk and how to get there. And I have clients that will never take on debt. I have clients that leverage every property. I have clients that are aggressive with depreciation, but they all have different tastes of what suits them and what they're navigating in their real estate business. So,
do you see more people that do this right, or more people that screw it up?
It depends. I mean, I think really everybody in this room is really in a great place. First off, because they're at least trying to hear and learn and stuff.
That end game thing, from what I've heard, I mean, I've talked to accountants and they tell me that most of their clients screw it up.
A lot of them, I mean, it depends. I mean, I have large commercial clients, but are very sophisticated. They're dealing with law firms, accountants, they're planning. They many times know these ins and outs. They know exactly what to do. They're always looking at deals. And really, I think it's getting the education and not taking everything. I mean, a lot of stuff does get screwed up. And I hate to say it's smaller people that really do end up screwing it up. I received a phone call from somebody that had sold the deal. They heard about a 1031. They had cash in the bank and wanted to talk to me about doing a 1031. I said, money's in your bank? Nope. End of conversation. There's nothing else to do. But then everybody...
At the end, when you screw it up, you've got $1 million in basis, and you didn't do it right. You thought you were going to pass it on to your kids, and then you need the money, and now you pay tax on $1 million basis.
Oh yeah, and really seeing that and understanding basis in properties, because right now I hear a lot of people talking about as Bigger Pockets is calling it, the BRR strategy. I mean, I hear that quite a lot, and and I want to say just in the last year or two, I started really hearing it called as the Burr investors, and that real estate's been happening like that for I don't know, as long, I know back to the 60s at least. I'm not that old, but I know it's been going on, and I assume as long as people would lend on property, they've been doing that strategy. So.
Do you generally think it's worth people taking on the complexity and taking the downside, or is it a small percentage of people that it's worth doing the 1031?
I mean, I think it really depends what you want to do. I mean, let's say a couple people are prepared, they're getting into a deal. I work with larger management companies that the management company, but then their group of investors, they're refinancing and they're returning capital all the time, and now it's an infinite return.
They're running the end game and they know.
Yeah, but then there are investors, they're keeping into the deal for longer term, and every management company on Northwestern Highway, that's how they raise money. is. But on the other side, it's not really for not saying unsophisticated, but somebody that doesn't understand it.
I see people doing $80,000 houses and they're going to kill themselves.
Oh yeah.
They don't realize that they're setting up a disaster.
Oh yeah, and
They come down to the end of it.
and then is what can happen is now I have, let's say, a $100,000 house. You're not getting 100% financing, but let's just say you have a $100,000 mortgage on it. And to me, I just walk away because I give it back like they did in 2008. But I only bought that property for 50 grand. So effectively, I buy it for 50. My writing sucks. But I buy that property for 50 grand, and then now it appreciates to 100. So now I go to the bank, let's say I get 100, and the talk about basis that we're talking about is...
Talking about refinancing, taking the money out?
Yes, so the first step of the BRRRR strategy that everybody talks about, I have 100 grand in my pocket, cash, which is good, but I've got negative 50 into that deal right now. If I sell Jeff my LLC, I'm going to be at $50,000, and or I sell him my LLC for 100. I've got a $100,000 gain that I have to recapture. Then on that, now let's say I just collect rent and I tell the bank, well, you can have this property back. I owe 100. It's worth 100. You can have or it's worth less. I'm going to have at least a $50,000 tax recapture on top of it, plus the cancellation of debt, and then there's some insolvency issues that come in.
How would that $50,000 be taxed as ordinary income or capital gain if you handed it back?
It's generally going to be most likely capital gain, but subject to recapture depreciation, depending on how your depreciation recapture. So a lot of times what I see in smaller transactions, I buy a house for $20,000 in Detroit, I refinance it for 40, let's say, and put 40 in my pocket. Now I'm negative 20. They sell it for 50 in the investor's mind, and I don't see this because I can't do this, but as a tax preparer, I have to walk you through, but I know it's being done and I've seen it on returns. In your mind, you bought that property for 20, you did it at 50, you did it on TurboTax, 30,000 is what you reported, you didn't properly pick that up. Statistically, you're probably going to be able to sleep at night. I'm not as concerned. But what's really going to happen is they ever knock on your door, you've got recapture issues. First thing they're going to ask is the IRS, show us your operating agreement. And now if you don't have the different provisions in your operating agreement, when you say, where's my operating agreement, that's going to be a distribution in excess of basis that now wasn't taxable when you sold it. It was taxable back when you took the mortgage 5 years earlier because it was in excess of your basis, just as if you owned it in an S corporation, where I'd say never own your buy and hold real estate in an S corporation. And if you're never going to refinance it, never going to do anything, LLC versus S corporation, you're going to have about the same tax exposure. But when you start doing, LLC gives me 10 options, S corporation only gives me 5, let's say. I'd rather have all 10 whether I use them or not. So this does happen, and I think people don't understand the recapture issues, but if you sell $1 million building, you're going to have a lot of issues and stuff. So, what?
Do you remember
The IRS might notice that one.
Yeah.
do you remember the numbers of the example that you just did, the very last one? That you refinanced it for
where I said 20 and then 40.
Yeah, can you tell me what the tax consequences are of that at the end?
So I mean, $20,000, I'll come over here. So $20,000 property, then I'm gonna refinance it for 40. Let's just say I'm gonna hold it at break even cash and expenses, and I'll throw out all that stuff and depreciation, but I'll be at negative 20 on this transaction here. Then let's say 2 years from now, I sell that property for 50,000. To me, I'm gonna get 10 grand, pay off my 40, go down the street. My investor mindset says, I bought it for 20, I sold it for 50, I made 30, I guess maybe I have to pay tax on 30 if I'm at home on TurboTax doing it myself. Or another investor mindset might say, well, I owed 40, I sold it for 50, I only made 10 on it. And I've heard people say that. Both of those are wrong, and just go do your own taxes. I'm not going to get you as good of a refund. You'll do better than me. But so that situation, now if I'm at negative 20, you give me 50, so I'm here, then I get my 50, I'm going to put 40 here, I walk away with 10, but now this 20,000 negative is going to add the 50, so I'm going to go back to a 30 and end up with a $20,000 gain, but I'm going to be paying taxes in that situation. So your exposure, but if you're doing it all within an LLC, let's say I have an LLC that owns 10 rentals, you might allocate debt, group your debt and allocate all the debt to me that provides basis for that negative 20. But if that same, I own 10 separate LLCs, I might not get basis in those other properties. And so from a tax standpoint, if you grouped all your properties and allocated all your debt to yourself, it might
That would be better to put it all together if you're trying to.
impact things differently, yes.
So hypothetically on that deal, if you
Hope that, any other questions, or, so I think kind of covered a lot of,
Frank, is there a way to extend out the time frame at all? I mean, really, logistically from an investor standpoint. Let's say you had a house that was a rental unit, okay, you sold it, and you were looking at maybe $100,000 right now, based upon what you got into with your expenditures and everything else. So now you need to reinvest that $100,000 or not, pay tax on it, you're looking for the deferment, but you can't find exactly what you're looking for, but you're looking in residential, a couple deals, but they're necessarily not under contract. Is there any way to extend that out?
well, generally it's going to fall under the 45 days, and then that's where you're going to figure out technically who the intermediary company is, which of the different strategies, the 3 property, the 200%, and then you're going to then go pursue those deals. So you really have that time frame, especially on smaller deals. You can either find something or not, but it could go to the intermediary and then fail in 45 days, and then it just, and actually I've never actually had one that did not go, at least get to the identification, because if they were meant to fail, they were always going to 180 to push it into the next year. So if you don't identify, I don't know if they actually, I don't think they give you your money back. It still goes the 180 days.
Okay.
So now let's say December 15th I close and I want to do this but not identify anything, I'm not getting my money roughly till early June. I'd have to double check that, but I've actually never run into that, and but I believe it actually goes that now if I'm trying to push taxes, now I don't get my money until June. So, but that's why they have the different ways, but you're going to kind of know, but you're not going to be able to extend those under normal circumstances. So,
Frank, quick question.
yep.
Let's say you take 10 single-family homes and you want to sell them to buy a multifamily.
That you're renting.
Renting.
Yep.
You want to sell them, buy a multifamily. Do you have to sell them in a package, or can you sell them individually? How would you structure that? Do you have to lump them all in a package, sell them all at one time together? Or can you sell them individually and lump them into a 1031?
So effectively, now that's going to come down to the qualified intermediary that you're using, and which is on a smaller going to be a title company. There's a couple title companies that do those type of transactions, and then some don't, but they're effectively holding your money in escrow is what's happening.
Yeah.
On a larger commercial property, the fees are still generally going to be worth it. I mean, I'm talking few or thousands of dollars, but so now on the smaller deals, transactionally, yes, you can do that, but now are you getting into them doing multiple amounts of work and your fees starting to outweigh the benefits? I mean, if we were talking 10 properties that were rentals, Airbnbs in San Francisco, that's going to be a substantial amount of money. If we're talking 10 properties at, certain areas in Detroit, your fees are never going to
Your fees
offset.
won't weigh it up.
Yeah.
But if you had 10 properties, let's say in the suburbs, that
Correct.
you got paid off.
Yes.
$100,000 properties, $150,000 properties. You could sell them individually. The title company or whoever you say holds the money, and when you get all 10 sold, then do you identify the property? You've got 45 days from that point to identify, or do you have to identify?
I believe it's from the first one. The only transactions that I've worked on that have gone to different sellers have been larger commercial. They're selling 3 commercial properties to these 3 guys, and they're closing literally days apart, and everything's identified. But I mean, if it's now, I'm going to throw these on the market and hope these 10 guys, I think there's going to be too many flaws to really get that to work. I mean, timing wise. Yeah, I'd have to double check that closer on the smaller, but on the multiple, if it's a larger, those things are already in place, and those have already been deals made in, offices before they ever got to the closing table anyway. So, but that's really where I think understanding the power of it, but understanding why not to explore it, or at least what the costs are. But that same strategy, if you're upside down in basis, because I've taken out a bunch, that might save you from some large recapture if you're going to put it in. But now you're really buying on being a landlord or an investor and getting to. So the person who's owning 3 or 5 rentals and just wants to go down that one street, this is really buying off too much for them and getting way too complex. So,
Thank you.
okay.
If I have a rental and then I sell it off and I take that money and invest it as a passive investor in a multifamily deal, is it still considered a 1031?
Not you won't be able to do that on a 1031, but if you're looking at it in a passive type investment, there is now the big things, qualified opportunity zones, and they're popping up, and any of the brokers. I mean, if we're talking truly like more at a REIT level, or like that you were going to do that, you could defer those gains into there, and I've got mixed feelings about the opportunity zones and a lot of the strategies that we're talking, the gain deferral, taking cash out tax-free, you lose all that with an opportunity zone. But now me as a developer, if I've got a rich guy over here that's got a bunch of Google stock that he wants to sell and invest, I'd love to do an opportunity zone, because I can tell him all the ways he can defer his Google stock and give me money to go do my deal. So as a developer, it's a great way for me to attract money, but I don't know if it was my money if I want to put it into an opportunity zone. So that's a way that you'd be able to defer it. But if I'm just selling one of these properties that I've leveraged, I have all this negative basis, and I just want to go invest it into REITs and collect the dividends and sit on the beach, you're not necessarily going to be able to do that. There is some ways with some public REITs to structure some things through tenant in common ownership, but it starts to get real complicated, and it really needs to make sense, and you're giving up a lot of control and stuff. And somebody that's been that involved, that far negative, has been managing their businesses, and they don't want to have no control over their real estate investment. So,
So better way would be to rather refinance it and take that money and put it in a multifamily deal as a passive investor, rather than sell your properties. Is that what you're saying?
you could do that, yes, but you need to then, as Jeff was saying, really understand your risk, because if I'm going to take all my single families, go leverage them because I want to passively invest into a multifamily deal, there's lack of control, lack of marketability, liquidity. I'm giving up a lot for maybe to get a return in 5 years, and there's a lot of good deals, but that's where you really need to know what you're doing, who you're doing it with, where you're getting the money. I wouldn't say go leverage the farm to go invest in a bunch of multifamily, but on another note, it's always a good way to feel out the different ones and who's doing what.
I'm just talking exclusively from a taxation perspective, not from whether the multifamily is a good or bad.
Okay.
Just from a pure tax standpoint, if I have my primary house with a lot of equity built in it, do I just take a loan against it, go and put it in a multifamily deal? That way I have different taxes.
I mean, from a tax standpoint, purely if you can get the money out of your house and get that and invest. I mean, some days I can say doing anything you can do to get started also is going to be better than not, you know. So, but borrowing the money, or let's say from your rentals, if that's where you need those sources because that's what you want to do, would be better than selling those rentals and selling your rentals and investing in the multifamily, because you can leverage it. But you really need to understand what you're getting into, because a lot of people make a lot of money, but a lot of people lose a lot of money. I've had clients lose everything, and I've had clients become very wealthy. So in 2008, I learned all the cancellation of debt rules. Never ran into that in my career, and worked a lot with that and the different code sections.
I'm trying to still understand his question, the answer. If he owns
10 rentals.
if he owns a rental
Okay.
and he has a lot of, or he owns a house, and right, and has a lot of equity in it, should he sell that house for tax purposes, this one transaction? Should he sell that house, use that money to invest in the multifamily? He's going to invest in this multifamily whether you think it's a good idea or not. Should he sell the house and invest in the multifamily, or should he take the equity out of the house that he has a lot of equity in and invest it in the multifamily?
Purely from a tax standpoint and a leverage standpoint, refinance and take the money and reinvest. Now you own 2 assets. You're taking
Thank you.
on debt. From an advisor standpoint, know your risk tolerance. So just because that can go south very quickly if it's not done, but so, and as a CPA, I got to qualify everything at least, you know. So, like I said, everything I said is lies. So. But because that will apply differently to different people's risks. So, any other?
Yeah.
Okay.
Can you tell us more about that special deductions or bonus deduction?
Okay. So I'm going to go on. I'll go on to the next one for the cost segregation. That then talk a little bit about that. So, one of the benefits talking about cost segregation, really planning strategy, you know, starts to separate the properties. And I hear a lot of people talking cost segregation. Cost segregation's, it's a theory done by accountants / engineers, and it needs to be a true study. So this building, I buy this building for X amount of dollars. As an accountant, I'm just recording the building based on the purchase price, allocating something to land. Cost segregation now is coming in and saying, well, these are drop ceilings, lights, boards, allocating assets based on some engineering background, appraisal background, and starting to qualify things for 5, 7, and 15 year as opposed to 27 and a half year and 39-year on residential and commercial properties. So a lot of times I'll hear the small flip or rental property, what can I depreciate? Well, if you're rehabbing it just to get it up to rent ready, that's really all added to the cost. And then if I'm buying this building, that's really just added to your cost. If you start to look at it, generally a cost segregation study, as they truly are done, are going to be very expensive. You do them more at the commercial level. You're not going to do them on the smaller single families. I do know of a company that does them for, I want to say they're $400 or $500, and they'll do them, but they're doing a lot of ratios and different things. But now as an accountant, if you buy a rundown property and you're bringing me, well, I spent this for the furnace and I had to replace this, and we're going to talk about it and how to start to identify things. So using some of the same theories, but I'm using it off of receipts and discussions, but I'm not just saying, well, generally a building like this uses X amount of square footage and whiteboards and lighting, and that's how they're doing it. So that's another strategy. And then with the depreciation, the biggest thing is the increased cash flow, because let's say you spend $100,000 on something, you're going to depreciate it over 27 and a half years if it's residential, or 39 years commercial. I want to start to get that as 5, 7, and 15-year property. Now with the new tax law, they've aggressively gone onto the bonus depreciation, and what's generally going to qualify as non-structural type improvements. So I buy a rental, I'm replacing the appliances. The appliances are there. To me, that might be more of a repair, or at least it's going to be a more accelerated depreciation. It's not going to be the cost of your building. But if I buy your rental property from you, all I have is the closing document. I can't really go through, well, really I've spent $500 on the refrigerator and I spent on the stove, and do my kind of napkin cost segregation is kind of what I call it. That stuff doesn't really fly anymore. But now as you're...
What if you put it in the bill of sale?
What?
What if you identify it in the bill of sale?
Now that's going to be different, and that's going to be better. So that would be enough evidence that, and then the buyer and really having that. So if you buy a multifamily, I might identify to the furniture and fixtures and start to identify it. It's no different than like with a business transaction, you're buying trucks and machinery and equipment, the real estate, the no competes. And
Will that withstand scrutiny most of the time if it's reasonable?
If it's reasonable, I mean, if I'm gonna buy a Bloomfield Hills home for $100,000 and $700,000 for all the furniture and furnishings, now they're gonna look at that, but it's got to be reasonable. But that would be a way to do that. But now, it might depend on tax situations, because the different assets, they might, now sell their real estate at a loss, and now they have a gain on all the furniture. So you and I'd have to agree what you're buying it at too. So, and in the end, nothing's free. If you're getting something, they're going to ding you on the price.
I got a question about appliances and just kind of amortized expenses. So I remember, I don't know, 7 or 8 years ago when I was managing multifamily, for a 300-unit apartment complex, we would keep these extensive appliance logs. And back then, at least in my understanding, is we would keep these appliance logs when we purchased it, when they were replaced or phased out, and a lot of those appliances were amortized out, a $500 refrigerator over a 5 or 7 year period. Same with like carpet and other things like that.
Yeah.
But I believe in the past couple of years, did something change with that, where there's some type of like threshold if you have a rental property or an apartment and it's under like $2,500 that it can be expensed in the same year?
With the repair regulations from 2012, that did change that. So, for instance, but with multifamily, it's starts to get a little different, and depends on. I've expensed $100,000 in repairs on multifamily with some of the different multifamily managers, and because they just routinely repair it.
We'll go in and replace 100 refrigerators.
Yeah, and really treat that more as repair expense that we're just going to expense every year, because they're doing more systematically with multifamily. And what you're talking about, even if you're expensing it, that's still from their maintenance standpoint, those asset logs that, well, that side of the project, we did that in 2015, then 16, 17. It's going to help with that, plus asset management. So from a tax standpoint, it still might be repairs, but I would say not track it. But I know on the multifamily, they're going to be much more sophisticated of where they track that from more of an asset management standpoint. But
So with that change in 2012 you mentioned, if someone has like a house and they have a refrigerator that needs to be replaced, prior to 2012, wouldn't they have to depreciate that over like a 5-year period? But now they can just deduct that and claim it as appliance repair in one year?
generally, yes. I might go either way depending on different things. I know sometimes electrical repair is going to cost a few $1,000s. Is that electrical repair, or did you have the electrical run because they stole your electrical service? So
Is there like a certain dollar amount though that is kind of a cutoff, or it's just case by case situation?
there's really, it's more, it depends if we're in year 10, if we're in year 5, the IRS might say, well, this should be depreciated, and they're going to charge some back taxes, and that they might take a different position. As long as you're consistent with your policies is what is going to be, start to evidence it, because I work with different investors that do different things, and if we're talking repairs, but now if you're buying a house that's been totally gutted, it's a full rehab, has no cupboards, no kitchen, we need to capitalize something. It's not even rentable at that point.
Okay. So if you're removing and replacing,
That's more going to be of a repair versus, but now if I buy your rental and now I'm going to go in and the area is changing and I'm going to just update it, I might treat that as a repair because it really was rentable, just I can get a better rent if I'm going to repair it and fix it. So that's going to be more, I might think as a repair. But then now on an asset that I capitalize, getting into the bonus depreciation, I may not expense it. I may prefer to record the asset so that you can track your asset, still take the accelerated depreciation, which is the same as expensing it for tax purposes, but two different theories. And really just keeping consistent, but some are, I want to deduct everything and I really don't care, but some clients, I'm going to have to walk them through that whole gain formula. We deducted all those expenses 3 years ago, we've depreciated that. Other people say, I bought the house for 10 grand, I put 50 into it, I know it cost me 60, but they forgot we deducted the 50 over the last 5 years in repairs. And everybody views things differently, so as I'm trying to communicate and get a feel for, we all look for whatever's best. When we're around the barbecue, we want the biggest gain. When it comes to tax time, we want the smallest gain. Everyone wants to brag. That I made the most on my house. And I hear it all the time. My accountant deducts everything for me. Everybody loves that barbecue talk, but what you really want to do, and I work with a lot of people, and I don't. Well, that guy does this, but I see a lot of different things. But everybody's risk, like we were talking, everybody's got a different taste for different amounts of risk of what they can do. So.
Can I deduct furnace, hot water heater, and AC?
I'm sorry.
Can I deduct or bonus depreciate the furnace, new hot water heater, and the air conditioner?
So generally with those, were they already there or?
They were not there.
Okay, so now you're adding them to that, and so with that, I would say that that's really going to be something that's capitalized, but then going to qualify for accelerated depreciation. But on another note, if it's a property that you're just replacing it, I might just expense it and never record that in the first place. So it depends, but I would say that would qualify for accelerated depreciation on that property, because it's really equipment that is for the house that you're identifying on that. So.
Can you explain about opportunity zones for taxation state?
About what?
You were talking about opportunity zones, saying some Google stock, something. I didn't.
Oh. So opportunity zones are new, came out in the new tax change. All across the country, there's different areas that are designated opportunity zones, and one side of the street might be, but it was based off the 2010 census. So like the center of downtown's an opportunity zone, but all that's already been all rehabbed. So there's not opportunity there. But if I buy a property in an opportunity zone, let's say for $50,000, the rehab has to be greater than the purchase price, so I have to put $50,000 into it. But then what that does is allows you to defer a gain 5, 7, and 10 years, and there's different steps on it. But I have to close on, the fund has to be created by a certain date, and then at that point you can purchase property, but you can't take that property. So by nature of just refinancing it and taking cash out would be a distribution. And I believe it would disqualify your touching that gain that you had to defer. So all the beauty of real estate you just lost, you'd be better off just buying it and refinancing.
So if you buy a property in the opportunity zone for $50,000, you put $50,000 into it, and you sell it for $200,000, your $100,000 is your profit.
In 10 years from now, in 2025, you have to pay part of the gain on the $100,000 that you deferred. You get to defer, and then in 10 years, I believe you will never pay tax on that next $100,000. So it's a great opportunity, but you're going to lock that money up for a long time. So.
Frank, we'll have to be out of the room by 9.
Okay.
That includes the breakdown time too.
Okay. Oh. Okay. So.
We have room for like one more question, one last question. Does anybody have one final question before we wrap it up?
Any?
Are you taking on new clients?
What?
Are you taking on new clients?
Oh yeah, always.
How do they get in touch with you, Frank?
Give me a call.
Do you have that on the slide?
What?
Do you have that information on the slide?
I think so. I'll give out a card and.
Can you say it out loud so if anybody listens to the video, they know how to get hold of you?
Okay. Best way is give me a call, 586-805-1040. Find me on Facebook. Look for Frank Alcini, CPA Nerd. That'll take you to my page. Like it while you're at it. Give it a like. Throw those numbers up. But give me a call. We can kind of talk, figure out a little bit more, and go from there. So right now, hope everything's filed for last year. Deadline was yesterday.
What's your number again?
What?
What's your number again?
586-805-1040, like the tax return.
I got one last question. So hypothetically, if you have a rental property and you've had that rental property for, let's say, 10 years, and you decide to terminate it being a rental property and you want to start using it for yourself, and you've already depreciated 10 years of that property, how is that situation treated?
So effectively, your basis is going to transfer over into that property, or your cost in that, in your residence now, and then you're going to run into, you can potentially defer the gain. There might be some recapture depending on how long you live in it and have it as your personal residence. But
so hypothetically, if it's an Airbnb, you own for 10 years, you've rented it out, and now you want to retire there and, live there till you die.
okay.
How would that work?
So right now, that you'd stop depreciating that property, and then that would effectively transfer over to your basis in that property. Then let's say you sold that property, and if you've depreciated it, let's say to zero in theory, and then it's in a certain area that appreciates well, you could effectively hit over in excess of the $250,000 or $500,000 exclusion, depending on single or married filing joint, still pay tax. Let's say now you sell it when you now let's say retire and get older, and then the kids sell the house and put you in the home.
The reason I'm asking is actually my in-laws have the same exact situation. They had this Airbnb, they've rented out for 10 years, and they want to retire at this house now, and they want to live there till they die.
Okay.
I don't know how I'm going to have to pay the taxes. Do I have to pay the taxes?
Well, then effectively, what happens is, I mean, let's just say it real simply. You said it's your in-laws.
Yeah.
So let's say effectively they both die, and then it goes to your wife, and let's say, does she have another sibling?
Yeah.
So let's say it goes 50-50 to them. They get a step up in basis, and that goes to where we were talking on the 1031s, that you have to die, and the situation, whatever your basis is, so their basis is zero, it steps up to the fair market value. So effectively that
So it steps up to the fair market value once
they die, and then you sell it the next day. There's no tax on that. They own an asset worth X. They sold it for X. They might have some closing costs. If they sold it a week before mom and dad died, because they were both on their deathbed and we're going to make things easy, they could have taxable gain.
Okay.
Some of these,
Better to wait till they die.
yes. And that elderly gentleman that I was talking about that had the recapture issue, if he held that largely negative K1 till the day he died, it would have stepped up to zero and just gone to nothing. And that's really where, once you head down the 1031 and accelerated depreciation, being able to hold it till you die. But okay.
Okay.
So think that.
Thank you, that was great.
Thank you.